So more on the tariffs, right? We're looking at 25% on Canada and Mexico. They're on track to start March 4th. And the risk to commodities could actually be high, especially with additional tariff deadlines on the way. One company with unique insights on this is Abaxx Technologies, an exchange and clearinghouse for commodities involved in the energy transition. So think of things like LNG, carbon, and nickel sulfate. Trading started in June, and Abaxx will soon launch for gold and lithium carbonate as well. Joining us now to discuss is Josh Crum, the founder and CEO of Abaxx Technologies, and Jeff Curry, Chief Strategy Officer of Energy Pathways at Carlyle. He also sits on the board of directors for Abaxx Technologies and is up late, so we appreciate that for you. Josh, let's start with you. You're in the weeds with this, right? What problem are you trying to solve for, and how's it going?
Absolutely. Well, thanks for having us here today. So our original thesis is what we call back to the futures. When you think about commodity prices, you always have to remember that these are very different than equity prices. You know, this is a very specific place and time for a very specific grade of commodity. And so over the past few years, you've seen a lot of indexation of commodity prices. But what we're really focused on is, again, back to the futures, where when you get to expiry, you get physical. And so the products that we've launched are all very location specific. We have 3 LNG contracts, for example, that price out of the U.S. Gulf into Europe and into Asia. So you have a very different price, which again, I think in this, the world we're heading into, is very important to be able to understand what that exact price and time as commodities sort of balkanize.
Well, absolutely, particularly with tariffs, because then you're going to see differentials spread out pretty much all over the world when it comes to different commodities. Hey, Jeff, when we talk about this kind of exchange, what is liquidity like? How does a typical exchange work with liquidity and demand? And what are we seeing with Abaxx?
Well, I think one of the reasons why I've always been a fan of Josh's technology goes back to the term he said, the localization. He uses a system like a modern day version of like LME warehouse system, so he can source the liquidity across the globe for the individual nodes in these different locations, which is a genius way to be able to create a lot of liquidity for certain nodes that typically would not have any liquidity. Very similar type of mechanism that the LME did in like 1788, but we don't see it in other types of exchanges.
This may be a dumb question, Jeff, because it's probably, one answer, but liquidity and transparency, is that going hand in hand? I mean, which kind of came first here, the chicken or the egg?
The transparency, you had to trust these people in 1788 or what these warehouses had. I mean, that's the whole key point here, is that you're able to take liquidity in all these different key nodes, source them up into one location, and create a much larger pool of liquidity that allows traders to come in. The LME uses a very similar type technique, but your point, I think, is a really important question, because you do have to trust what's going on in these different locations, and the transparency is key there.
All right, and Josh, to you too. I mean, when we talk about some of the main commodities that you have on this platform already, obviously a lot tied to the energy transition and EVs. We're talking nickel, lithium, cobalt, with maybe the exception of nickel. I mean, some of these aren't. Is there a necessity to trade these that much? I mean, it seems like most of the contracts you would see for cobalt, and even to a certain extent when it comes to lithium, are just kind of one-on-one contracts. You're talking about bulk contracts. Do you need those intermediaries there? Is there a need or demand for that?
Yeah, absolutely. And so I think what's important is we really try to match what's already happening in the physical spot trade. And so we actually spend, years running around places like, Geneva and Singapore and Dubai and Houston, and you really talk to the physical traders. So they are trading spot LNG cargoes today. The problem is they don't have a great price reference to do that. They may be Henry Hub Plus, they might be TTF minus, they may be some broad global price assessment, ends up in JKM. But, again, we look at how they're trading today and then match our futures contract to go to expiry and match the physical trade.
How's it going? Like, you guys just started trading in June, right?
Yes, absolutely. So we've had some open interest. We've had, but when you start with physical trades, you're really looking at physical block trades first. So we don't start with all the financial market making. I mean, we have market makers on there. They're showing bid ask, but really to bootstrap our futures curve, we really want those physical physical over-the-counter trades to move on to exchange. And so over the next few months, you're going to see more and more LNG trades. Next week, we launch our lithium carbonate contract, which is incredibly important. To Jeff's point, right now the price assessment is really what's happening in China. We've got a Baltimore delivered lithium carbonate contract that will show you what's the price of physical lithium carbonate in North America.
That's actually way cool because it's really hard to find that. If you're a reporter, you're like, where am I going? How am I getting this price? Hey, Jeff, speaking of, this will be very helpful also when it comes to managing tariffs, right? Because if we're going to have a tariff on something, particularly a rare earth or even tin, it's going to be hard to know how they all trade. Have you noticed anything yet with all the threats out there?
Oh, gold, must be top of the list right now. And I think, right now the arbitrage between New York and London is wide open. Records amount of gold are going into the U.S., trying to get in before any potential tariff is implemented, because it's the easiest way to arbitrage that given the low cost of storage. We're also seeing it in copper, but aluminum is the one that's priced it in most directly. And I think a couple things with aluminum to keep in mind is, one, that while it's priced into the commodity, it's not priced into the equity, like Alcoa. What is that telling you? They don't believe this is going to last long because it's going to be so disruptive. The other point to keep in mind when we onshore all these metals is that they're far more energy intensive. I like to say, if you think AI is energy intensive, aluminum smelting is 6 times more energy intensive than data centers for AI. So bringing this onshore will make a tight power market even that much tighter. That's why the equity market doesn't believe this is sustainable.
Well, and then this gets to the issues, though, Jeff, when we talk about Washington policies, some of the changes in policies that are either promised or on the way already here. Is there a sense here that there will be balance? Because right now you have a market on edge, and I'm talking about financial markets across the board on edge right now, because at least in their view, there does not seem to be a balance.
Well, I think they'll watch and see how the markets react. The one thing I want to point out here is, everybody wants to say that these tariffs are inflationary. It's a one-off. Once they're put in place, it's not inflationary. What is inflationary is if you go in and start digging in and building new aluminum smelters and crowding out power and things of that nature. But the tariff and the tax in itself is not inflationary because it's a one-off. But I think the one point why the market's getting a little jittery is you add them all up now, it's like a tax of 1% of GDP. So it is relatively a significant tax. But really the way to think about it, it's not inflationary, it's a tax. Then the inflationary question is whether or not they actually go and onshore all this stuff.
Jeff, before I let you go, because you brought up gold, I got to ask, what's the upside potential here? You got to give me a call on something.
I'm very positive on gold, just given the fact that, you have a lot of political uncertainty. People are going to be, as we back away from the Bretton Woods system of, the U.S. dollar, the exorbitant privilege of the U.S. dollar, you start taking that out of the system, which is the implication of breaking down NATO, breaking these trade relationships. You're going to have to replace it with something. And those some things you replace it with are gold and Bitcoin or crypto. But gold is such a larger market than crypto. That's part of the reason why gold continues to rise. 3,000 will tell you, but that's easy right now.
Oh, there's your headline, Alex. All right, Jeff, got to leave it there. Always a pleasure. Jeff Curry, of course, the Chief Strategy Officer over at Carlyle. And our thanks there to Josh Crum. He's the founder and CEO of ABAX Technologies. We should point out stocks now hitting session lows once again.